is Kelly Lamarca. I work at the National Office of NTMA. I wanted to welcome everyone to today's webinar, which is being presented by CBIZ. They are one of our national associates. I actually have with me Rich and Vicki. So Rich Herms is the Director of Property Tax. He is out of the St. Louis CBIZ office. He has over 30 years of property tax experience throughout the United States. His expertise includes inventory valuation, review of landlord billings, assessment reviews, tax bill reviews, protests, and appeals. I also have Vicki Resnichek. She is a manager out of the St. Louis office. Vicki handles all personal property audits as well as protests and appeals. We are very happy to have them on the call and doing this webinar. So I will go ahead and turn it over to Rich, who will be the first presenter.
Thank you very much. As most of you probably on this webinar know, a major expense to your bottom line is your real estate taxes. You know, have you ever wondered when you get that tax bill how the valuation has been arrived at? We're going to kind of go through the different approaches the counties use and talk about those a little bit as we go along. The county uses a cost approach, the income approach, and the sales comparable approach to value your property. The cost approach is probably used the most out there in mass appraisal. The counties have manual, it used to be manuals, now everything is pretty much on computers. They just plug in various variables from your property on height and size and land, and hit a button, and poof, you've got a number. Right, wrong, or indifferent, that is usually what the counties will mail out to you, and you have a chance to discuss it with them once you get the notice. Another approach that is used once in a while by a jurisdiction is the income approach. For industrial properties, I haven't seen this used that often. It is, but it's very rare. In this approach, the county will assume the rents that are paid on your industrial building. They'll also estimate your expenses. They'll have a cap rate formula that they apply to the income. And in some locales, the assessment office will request you annually to send in your income expenses so they can use that for their valuation. The last approach is a sales comparable approach. We've only seen this in some of the bigger jurisdictions. This is where the assessor's office will monitor all the industrial sales in the county, in the town, in the state, and they'll try to adjust these sales accordingly to come up to help them value your property based on the sales of the other industrial properties in the area. You know, a few years back in, late 2007 through 2010, when the economy was starting to decline, we saw quite a few industrial buildings closing down, shutting down, some being sold, or just sitting there vacant. And basically it was all based on, once the economy started going south, people quit buying, people quit manufacturing, so these plants were left to sit idle, not used up to their full potential, and the values started to decrease. Most of the assessors, though, back then, they didn't reduce them on their own. You still had to go in and ask for a reduction, file appeal. what have you, to get the assessor to even pay to look at it. Once they have your value on their books, they really hate to go in and lower it. That's money out of the school district's pocketbooks, and it's not something they do on their own. When the economy started changing over the last few years, there's more money out there. There's interest rates are low. People can go start buying these again, opening back up, operating. Once this perception of an increasing or improving economy happened, assessors started to raise the values. These values, if you hadn't appealed your value in early years, all of a sudden now you've got a value that should have been down that the assessor is starting to raise again. So you're kind of getting double whacked there. We can see now the way it's going, we're seeing a lot of increases, big increases nationwide, and not only on our industrial properties, but it seems like any kind of commercial is going up in all areas. We haven't seen any areas that have not started to come back. You know, once you receive your assessment notice is the time to pay attention. If you wait for your tax bill, it's usually too late to do anything whatsoever for that year's assessment. We've included, the next couple pages are states and their appeal deadlines. This is generally correct, but there's always some changes. Like Missouri, statute, it's supposed to be the third Monday in July. Well, they have first, second, or third Monday in July in some of these cities. So that statute really doesn't matter. Counties kind of act on their own. For instance, Illinois, excuse me, Illinois values every township at a different time. So it's just, if you've got property in any state or county or township and you think it's overassessed, you really just have to check with the assessor. So that's basically it in a nutshell on the real estate. I'm going to turn this over to Vicki, who wants to talk about the personal property.
Hi, good afternoon, everybody. My name is Vicki Resnicek, and I also have about 30 years of personal property tax experience. Been with CBIZ 10 years now. Prior to that, worked with Rich at May Department Stores for 19 years. I have experience preparing and filing business personal property returns in taxing jurisdictions across the United States. Taking note that when these returns are prepared, it's not just one return per state. It's taxing jurisdictions. So you have counties, you have villages, you have cities. So there's a lot of quantity there. And also the types of industry and rules change, so that keeps personal property exciting, as you can see how excited I sound. Okay, so I know that, like Rich said, you know, real estate taxes seem to be the big money, and everybody always takes that into consideration. But I think a lot of companies forget about personal property. You know, you think about your tables, chairs, desk, and you think, well, how much tax expense can that generate? Well, and I think probably a lot of you know that it can mount up, and you'd be very surprised of how much personal property taxes are out there, and how you do have to accrue for those, depending on, you know, what type of company and how much personal property you have. So I'm hoping I'm not drilling down too much for everybody, but let's just start off by discussing what is personal property. And the very general definition is it's property that is tangible, it's mobile, and not permanently affixed to real estate. So if we were to get into examples, you know, the obvious would be machinery and equipment, such as forklifts, boilers, scrubbers. Then we have office furniture and computers. And then for warehouse, we would have equipment in the warehouse. Inventory is also taxable in certain states, and that is a significant expense to a company. So inventory can have three components: the raw materials, the work in process, and the finished goods. So we have certain states, not all states, but we have certain states that tax inventory. And we have Arkansas. I'll just throw out a couple states: Arkansas, Kentucky, Louisiana, Mississippi, Oklahoma, Texas, to name a few. So in keeping with that, so as clear-cut as equipment, furniture, tools, and movable tangible property are, you know, those are pretty obvious. There are gray areas such as leasehold improvements or tenant improvements that can be construed as real or personal property. And I'm finding that now that more municipalities are auditing, leasehold improvements are really coming into play with them trying to decide whether they're going to say that leasehold improvements are personal, or as we try to argue them, as affixed to the real estate and then are assessed under real property. So the definition of leasehold improvement or tenant improvement would be an alteration to a building so that you configure that space for the needs of your business. So if we take a big air conditioner that sits on top of the building that's going to cool the entire building, of course you'd construe that as real estate. It's going to be assessed as real property. It's not going anywhere. That ton, how many tons of air conditioner is not going anywhere. So that's one type of, I guess, to me, that is there. It's really not an improvement. However, if you have carpeting or flooring, wiring, something to that effect, you know, you could argue that, well, it's of permanent nature and it isn't really intended to be removed or replaced because it would cause damage to the real estate. So it's not considered tangible personal property. So when it comes to leasehold improvements, you know, there are factors to consider, and I guess of them would be, you know, who owns the property? Is it the taxpayer or is there a landlord? What's the intention of the alteration that you're making? Is it there to be a permanent part of the realty? Therefore, you would say it's classified as real estate. The lease itself would state whether the property becomes the property of the landlord at the end of the lease or something different. So I guess the most important thing there with dealing with leasehold improvements would be to make sure that those assets are reviewed, and the purpose is to avoid the double taxation, because we certainly don't want it to be assessed as real property and then find out that it's also being assessed by business personal property. And I can throw out an example of that. In Louisiana, they seem to want to throw everything into personal. And if you request the record card for real and you see storage on the real estate record card, but your personal property work papers says storage, or there's an indication on your notice of value for storage, you know, well, how do we have storage in two places? And sure enough, it came down to these grain bins that they were considering storage and had them two places. So, you know, don't be afraid to ask questions or request that type of documentation from the assessor's office. So now I guess we'll talk about, the process of reporting the personal property assets that you have on your books. So personal property is self-declaration. So they send you a form. Nowadays, a lot of things are online, but it's a blank form. And you have the ability to make a distinction looking through the assets on your books and determining if those assets are reportable as tangible personal property, or if you look at them and you say, no, carpeting to me is real property. So you have the form, you have your fixed asset ledger, and you kind of pick it apart. So you go line by line and you first determine what you're going to report as personal property. Then when you report it, it's based on the cost, historical cost, year of acquisition, and then each jurisdiction has their own percent good table or depreciation table. So you're no longer looking at anything that you would look at for federal purposes. You're now paying attention to this jurisdiction, and if they say your machinery is a 10-year life because you're a manufacturer, you know, I guess that's where your expertise comes in and says, well, my stuff on my books is really only a 7-year life. They might say, sorry, this, you know, it's a 10 here. So you do need to pay attention to the factor tables, and then you apply cost, year of acquisition, times that depreciation for that year to arrive at a fair market value. Inventory, on the other hand, when you report inventory, there is no depreciation on inventory. So inventory, you either look at a 12-month average, depending on what state you're in, or what was your cost of the inventory on January 1, or whatever that assessment date is. Most of the time it's January 1. Getting back to fixed assets, machinery, equipment, computers, if you have these items on your books for 10 years and your asset, it's still on your books, but for federal purposes, net book value is 0. Well, that doesn't matter to a assessor's office. They will keep a value on that piece of equipment forever, as long as you have it on your books and you're reporting it. So what you need to understand about that is your net book value says 0. So you're thinking, well, I don't care if this computer is on my books for 20 more years. I don't care. Well, you kind of do care because it's subject to personal property tax. So if your preparer is taking it verbatim off of your asset list, they're going, oh, look, we have a computer. It's from 1800, but it needs to be on there because the books say it does. Well, the county is going to say computers are at a 5-year life. Therefore, the residual on a computer, that residual percent is 20%. Maybe not that high, but, you know, 10%. So you will be paying tax on that computer literally forever, as long as it's on your books and you're reporting it. So it is important to really look at those assets, dissect them, and then also from year to year when you file a return, now the next year comes, you're going to file a return again. You need to identify those assets that have been disposed of and remove them from the asset list, from the return, or you're going to continue to pay taxes on them. So in moving along, not every state taxes personal property. So there is slides 16 through 19 that identify the states. But for instance, here in Missouri, yes, we assess personal property, equipment, vehicles, no inventory. But in Illinois, which is right across the river, they do not. So, you know, interesting, a lot of eastern states do not tax personal property. I guess in talking about kind of backtracking a little bit, so if your preparer or somebody in-house is preparing these personal property renditions and they're looking straight at the asset ledger, there's a very, very high chance, probably 99% chance that you're overpaying on personal property because, again, the books could say, yep, carpeting, personal property. That person's just picking it all up and throwing it on the rendition. So something to definitely pay attention to. And lastly, surprisingly, how inconsistent the jurisdictions are with what they do consider taxable. You would think that overall, you talk to Greene County in Missouri, you talk to St. Louis County in Missouri, there should be consistencies there. Well, you'd be surprised. You have to become familiar with these jurisdictions and what they do consider taxable and their methodology. So you could call a jurisdiction and talk to someone and ask them, what do you consider a leasehold improvement? Is carpeting taxable as a leasehold improvement? And Mr. Smith says, nope, not taxable. You call another county, same state, you talk to Mr. Brown, and he tells you it is. So just another thing to keep in mind, and of how, you know, there are these nuances when you're preparing returns at such a level and quantity within a state. So let's go ahead and roll forward to after we have prepared that return and we've sent it on, the role of the assessor. So you send your rendition in, and it should be the basis for the assessor's assessment. Now, we've learned, because you get these notices of value after you have filed the return a couple months later, and you look at it and you say, wow, that's not what we sent in. That's not the value we came up with. Or the value hasn't changed from last year. Same number, same exact number. So what you find is some of these big counties, Dallas, Harris, and Texas, they get so many renditions. They have to get a value out by a certain time. So now you look at your notice and your number hasn't changed. Your value hasn't changed. Sometimes good answer, sometimes not a good answer. If you had a lot of disposals in the prior year, if your inventory went down, well, you're hoping for a lower number because you've accrued a lower tax that you're pretty excited about to tell the client that they're going to be paying less. Then you look at this notice and now you've got a higher number on there. So you really do have to pay attention to those notices and compare them to your rendition. There's also a deadline on those notices to appeal. So if you see a discrepancy, you look at that deadline. It could be a couple weeks out, it could be a month out, but you best pay attention to that date, because if you don't follow up with an appeal form, you don't file a protest, you're probably pretty much out of luck with that number changing. So with that being said, now it seems like these jurisdictions are getting away from paper. Sometimes they only send stuff out if there's a significant change in value. Well, what's significant to them? I'd like to know any change in value so I can make that determination if I feel that something needs to be done. So being proactive is not a bad thing, but it's time consuming. If you don't get a piece of paper from them and you don't hunt it down, they could say, well, too bad, so sad, your time is up and you can't appeal. So now you're stuck with that and the tax consequence till the next year, till you refile and hopefully, you know, follow up. The good part about the internet is the larger counties, now you can go online, you can search by property, and you can most likely get that information. Smaller counties, jurisdictions, you know, you could have a guy working out of his basement in some of these places, and yeah, so it just differs. It just differs. Also keep in mind, if you're going to appeal something, I think the first level of informal, you can talk to someone at the jurisdiction, hopefully get some work papers, see where they're coming from, possible to make a change over the phone. They picked up a wrong number, depreciation, you don't agree with it, you give them a reason, they make a change for you. If they don't, you know, a lot of the bigger counties like to appeal. They don't want to be bothered. They've got too much work right now. So when you file that protest, you know, at the first part of that, you can most likely just say property overvalued, something to that effect. But just keep in mind, there's going to be documentation needed to support your argument. So not a bad idea to have that stuff on hand, you know, your inventory support, asset list, whatever they're going to want. So, and most importantly, again, if you haven't appealed, you haven't sent in a protest, once that tax bill is generated, you are then responsible for paying it for the most part, and it is too late. It's too late to protest. So a lot of these counties close their, I guess you could call it close their books. You know, they go through their process. Now they've closed their books for their calendar year or their fiscal year, and they've moved on already to the next year. And now you're left with this tax bill that you don't agree with. So just keep that in mind as you're looking at these notices of value and deciding if you're going to protest the value. So this is where I explain how important I am. Okay, so I think one of the very important things is to properly classify your fixed assets. So now you've determined what is personal property, or you've said, nope, I'm looking at my books and I think this is real estate. I think it's improperly classified for what I want to report on my return. So just very important to, again, go line by line on your asset list, dissect it, give it a good look. If something doesn't have a good description, then you probably need to go seek out more information. Again, with these leasehold improvements or what we consider real property, lighting, carpeting, flooring. On the books, they could be classified as personal. For personal property purposes, we'd say they're real. I don't want to go over that too many times, but very, very important. The proper classification of personal property assets can help your cause with quicker depreciation. So it seems that the computer category is pretty drilled down to like laptops, that kind of thing. Okay, then you got your servers, but I'm seeing in companies that there are a lot of like robot type of pieces of equipment that are very tech, they're computerized. So, why not try to look at those classifications and say, well, these are like computers. And if you can't throw them in the computer category, there's got to be something that, maybe you can come up with when you look through all those categories and all their classifications to know that these things are going to be obsolete. So just something to keep in mind. Another thing, you've got a piece of equipment that's very costly, but it's made up of computer components and software. Well, for the most part, we say software is intangible. So might be worth it to look into that piece of equipment. Does anybody know how much of the cost is identified as software, or how much of the cost of a piece of equipment has computer components? So just something to keep in mind. I know it's digging, it's more time and effort, but you're talking about a big piece of equipment. It could definitely benefit you. What I try to do, and part of my job, is to identify tax incentives and exemption opportunities. There are Freeport inventory exemptions that are offered in a variety of states. There are manufacturing exemptions that are offered in a variety of states. We just talked about software, and even though we believe software is intangible, some states clearly exempt it. Others want to say that there's a difference between what you buy at the store and what is custom to your company. Another important thing when it comes to personal property assets and cost of an asset and what type of asset it is to kind of pick it apart. You've got assets that are on the books with descriptions that say repair, replacement. You've got assets that could be so general that would say remodel, renovation. Well, you could pull the invoice and see if you could really pull some intangibles off of there. So you might have engineering costs. You might have design costs. There could be repairs. There could be transportation, training. Well, if that stuff isn't identified, then you're going to be paying and reporting on the whole ball of wax there. Another thing to keep in mind with assets is, and I would believe that your business could relate to this, when you have assets that are labeled as converting, modification, refinishing, rewiring, relocating, or an upgrade to something. I guess the questions I ask is, are you adding value to that piece of equipment? So if you're converting something or modifying something, sometimes you have to ask so that you can make sure that you're reporting correctly. You certainly don't want to report additional money for repair if that piece of equipment is just going to keep functioning as it was before. So asking the question, does this new addition add value? And if it replaces something, if it replaces a piece of equipment, boiler replacement, well, where's the boiler I replaced? Is it on the asset list? Do we see it being disposed of? You don't want to carry 10 boilers if there's not 10 boilers. So just something to pay attention to. Another, and this is pretty much, I guess, a rule for Missouri, but you actually can take your cost and reduce your cost by freight, installation, and sales tax. So most, I think all rules would say that your cost you're going to report would include sales tax, installation, and freight. Well, in Missouri, after, I think, 2006, new regulation, you do not. So once again, might have to come up with some reasonable way to pull those costs off of there so that your cost is less that you're reporting. Another thing to keep in mind is like pollution control. So if you have equipment and it somehow has, you know, it monitors control of the air, water, noise, there are exemptions out there for that type of equipment or cost. Another thing that we do as far as getting a better understanding of remodels or idle equipment is to actually go to the plant, go to the warehouse, you know, take a look and make sure that the assets on the books mirror what's in the facility. You know, again, we want to make sure that old assets are being removed from the books if they're not in fact at the facility. We don't want to report what we don't have. Okay, so we are looking now at recognizing special treatment. Just a couple things. If you acquire a business and you now have purchased assets at today's market, we sometimes look at reporting those assets at today's cost. So whatever that purchase cost was that the company just bought the assets for. You have a lot of jurisdictions that say, nope, same asset was there yesterday, is there today. That table was worth $100. That's what we're assessing, you know, that's the cost. So just something also to keep in mind as far as special treatment of assets and the reporting of them and the cost that you would report on your personal property rendition. Looking at maybe looking at reporting them or taking both ways, historical cost versus purchase cost. What kind of answer are you going to get, and how would you argue that? Special treatment on equipment with obsolescence. So you've got functional obsolescence and external or economic obsolescence. So you've got a piece of equipment with a design flaw. You've got the same piece of equipment which is working good, except that now you've got overseas companies who are producing faster than you are. So, you know, we've got the whole demand, product demand for you is much less. So with those two things in mind, you know, you could go to the jurisdiction and see what they, you know, what can they do for you on that? Is there special depreciation that can be allowed? Obviously, once you argue your point, they're probably going to ask for a bunch of documentation just so they can cover themselves if they do allow you to use some special treatment. Idle equipment. Idle equipment could be a large piece of equipment that you purchased. It's sitting somewhere. You had every reason to believe you were going to use it, but the project fell through. You're not going to use it. So it's sitting there on the assessment date. Well, you could argue that, again, you purchased it, it's sitting there, you purchased it, it's got a cost, however, it's not doing anything. It's no longer being used, or it was never used, or it's no longer being used. I had a client that had a large piece of equipment sitting there waiting for sale. And every year it sat there for sale. So that cost sat on the return with the depreciation that they deemed appropriate. And finally we said, no, this is not generating income. It's not doing anything. So the county allowed us a different depreciation table, and it helped. It helped the cause. Leased equipment, something else that you may want to pay attention to. I think a lot of companies don't even know what they have when it comes to leased equipment. And I guess what I'm saying is you're not leasing anything out, but the company, the office, the warehouse, they're leasing forklifts. They're leasing computers. They're leasing, shoot, Carrie, what else are they leasing? Trucks. They're leasing things for their use. And nowadays, I think companies are leasing even more. Well, you don't own it. It's not on your books, but all of a sudden you get a tax bill. You could get a tax bill from the jurisdiction. And they say, hey, you guys have a printer, you're leasing from Rico or Copier, and you owe us tax. Well, again, nice to know how the lease reads. Did we have that equipment on January 1st? Did we have it on the assessment date? Is this a valid tax bill? So just something else to keep in mind. What you're looking at there, you've got a list of states with the filing date when the returns are due. You've got the valuation date, which would be the lien date or the assessment date, so whatever you owned as of that date. And then the very last column, comments, you've got inventory, if that state taxes inventory. Keep in mind, though, there are exemptions possibly, and manufacturers, retailers, is there a difference in how that inventory would be reported? And the states that do not assess personal property. There you have New Hampshire, New Jersey, New York. So you can run through those. Okay, before I turn it back over to Rich, again, just important that, there are these Freeport exemptions on inventory that are out there. Don't know if they're applicable. There's criteria, there's qualifications, there's applications, there's competitive exemptions, incentives. So just know that they're out there, and if anybody needs more information on that, you can certainly note a question, but I think that's about it for me. So thank you very much, and I'll turn it over to Rich.
Right. We kind of hit on this earlier as far as taxing jurisdictions and what we have seen this year. Like I said, most locations we're seeing increases in commercial, in industrial. Seems like all places we're seeing increases in residential. And it's just that most of these locations are strapped for cash, and they're doing everything they can to raise capital. What can a taxpayer do? Again, you got to pay attention to the valuation notice when you receive. For real estate, the time's usually short to appeal. If you know valuations are out there and you haven't received a notice, you have to go online and find it. There's no excuse from a county by not receiving your notice that you don't have to pay. Also, if you've got questions or you're unwilling to try this yourself, you can consult a tax professional like Vicki or myself, and we can go through all the processes for you. Again, the next page, it just kind of hammers on the same thing. It's just we've seen so many clients over the years not paying any attention to their notices, get the tax bill, and then call Raising Cain that their taxes are so high. It's so imperative that you pay attention when those notices first come out. Again, every business has personal property. A lot of states tax it, some don't. Personal property values are going up too. The same way, they don't give near the deductions and breaks that we used to get. It's just all money for the poor school districts and
Children.
Yeah, and the children at school. And if you don't do something yourself, it's not going to get any better. So you really got to pay attention when the time is right. CBIZ, we've had a property tax group here for a long, long time. We've worked all over the nation. We've got databases of sales, market leases. We're especially on Vicky's side, she knows what jurisdictions are hammering on carpet or which ones let carpet go and what have you. So just her experience is priceless on that kind of stuff. We can review your fixed assets for you. We can review your personal property redemptions. We can look at your real estate valuation just to see if we think you have, if there's any savings there. That's the whole goal for you guys hiring us or any other sales tax consultants, is to save money. I think we're about at our hour, so Kelly, we're done. So if there are any questions.
I did not get any questions relating to the webinar. Actually, hold on, I do. From Janelle Davidson, wanted to know, what about the equipment the company owns that moves from job to job and state to state, and is not ever physically at our location?
All right, we'll let Vicki handle that one because she's running into that over and over and over again.
Okay, I'll just equate that to what I know with clients. I prepare their returns. Again, the basis for the return has to be something. So you have to have a fixed asset list. And even though the equipment might be in Missouri for 3 months because it's on a job, now the job's over, now it moves over to Illinois, which doesn't tax personal property. It all comes down to the assessment date. So if Missouri's assessment date is January 1, your project, that equipment, wasn't here on January 1. And the thing of it is, somebody's got to track that. And I know that say corporate who keeps the books, yeah, there's got to be some way to track that. Where you run into issues is you've got a project that's right off the highway, and the assessor decides to be out on December 31st driving around, and he sees your big crane with your name on it. Well, he's going to be sending you a rendition, and he's going to expect to see that crane on there. So, yeah, the equipment does move, but you got to report it somewhere. So I know the company I deal with, they had a hard time. The accounting girl had a hard time saying, okay, I'm going to get everybody together. You guys got to start tracking this stuff where it is located. If it's at a job site, if it's back at the yard, where is it? So it's not easy, but it's got to be tracked somewhere. So I don't know if that answers your question. I hope it does.
Janelle, I actually unmuted you. Did that answer your question?
Sort of. So does that mean I have to report in every state where the equipment is then?
No, it's based on the assessment date of that jurisdiction or that state.
Okay.
So if on January 1, which is most states' assessment date, where was that crane? On January 1st.
Okay.
And that is the main focus of where to report that piece of equipment.
Okay.
I mean, you're not going to report it 3 times because it was at 3 different places throughout the year. Just wherever it was on that assessment date. And, your books, your fixed asset ledger, if it showed it in Missouri last year, but it now moved, I would take it, it would be on my Missouri return last year. Now this year it's off the Missouri return because it wasn't there.
Okay.
And now you can certainly call me and we can talk about it at more length if you want,
Yeah, I might do that. Thanks.
Okay.
Okay, perfect. Are there any other questions? I don't have any in the any other ones in the chat box. As everyone can see, Vicki and Rich's phone number and their email addresses are up on the screen right now. As I stated in the beginning, this was recorded. We will be sending this out to all attendees and everyone who registered in the event that someone was not able to attend. And I do urge you to reach out to Vicki or Rich for additional questions. I do want to thank both of them for taking the time out of their day to put on this the presentation and to speak with everyone. It was extremely valuable, and hopefully you guys saw value in it as well. And I do again want to thank you for attending.
Thank you.
Thank you.
Thank you all.
Thank you.